Hello and welcome to Smart Insight Traders. My name is Alan and today we are going to start a new video series where we are going to learn about my unique perspective of analyzing the financial markets. We are going to kickstart this series by learning about the most fundamental concept in our strategy, and that is fair value gaps. Fair value gaps are the heart and soul of what we do here at Smart Insight Traders. So without further ado, let's dive straight into it. But if this is your first time watching this video, please don't forget to like this video and subscribe to our channel. Let's take a quick peek at what we are going to learn in today's video. What exactly are fair value gaps? How are they formed? What do they tell us? And the most important, how are we going to use them in our trading? So let's start by defining what a fair value gap is. A fair value gap is a simple 3-candle pattern where there is a gap between the opposite extremes of the first candle and the third candle. Let's understand this in a much more simpler way. We work out two scenarios, a bullish scenario and a bearish scenario. In a bullish scenario, when there is a gap between the high of the first candle and the low of the third candle, that is a fair value gap. Similarly, in a bearish scenario, it will be exactly the opposite of this, in which there will be a gap between the low of the first candle and the high of the third candle. That is all that a fair value gap is. It's a simple 3-candle pattern with a gap between the first candle and the third candle extremes. Now let's look at this 3-candle pattern a little more closely. Let's look at the anatomy of this 3-candle pattern, how it is formed, what these individual candles, the 3 individual candles, what do they look like, and based on how they are formed, what do they tell us. So the first candle is the least important. It is the starting point and it can be of any color. It can be a red or a green candle, doesn't matter. It can be any type of candle. It can be a full body candle. It can be a doji. It can be a hammer. It can be a pin bar. It can be anything. It doesn't matter. Like I said, this is the least important candle. It's just a start point for us. The second candle is important. The second candle will always be an expansion phase. This will be a big candle, a full body candle, most preferably closing towards extremes of that candle. The body of this candle, like we said, is going to be a full body candle, is going to generate the actual fair value gap. Now, let's look at the third candle in the pattern. For us, the third candle is the most important candle. The third candle is going to define what type of fair value gap it is, whether it is a fair value gap or not, and what are we going to do after that fair value gap is formed is all defined by the all important third candle. Now, the third candle can do one of 3 things. These are the only 3 scenarios that are possible. In one scenario, we don't get a fair value gap, and in the other 2 scenarios, we get fair value gaps, but they are of a slightly different kind. Okay. Scenario number 1, this candle is a kind of a consolidation candle. It doesn't do much. It might just trade a little bit above the high of the second candle or not, or it can just consolidate in a small range but does not trade into the high of the first candle, forming, and it most importantly closes below the high of the second candle and thus giving us a fair value gap. When we normally say there is a fair value gap, this is the type of gap, this is the type of pattern that we are talking about, where the third candle closes below the high of the second candle and there is a gap between the low of the third candle and the high of the first candle. We are taking bullish examples because it will be easier for us to go through these different variations, taking to just one scenario. Second scenario is where the third candle continues the momentum that was set up by the second candle, trades above the high of the second candle and continues to expand and closes above the high of the second candle. This fair value gap that is created is called as a breakaway gap. We are going to learn more about this breakaway gap as we go further into the video. The third scenario is where the third candle trades back into the high of the first candle and thus preventing any fair value gap from forming, and we don't get any fair value gap. So the situations that we are looking forward to are scenario 1 and scenario 2, where we get either a normal fair value gap or we get a breakaway gap. Now that we have seen the anatomy of a fair value gap, we've broken it down into its individual constituents and the different scenarios possible. Let's look at the different types of fair value gaps. We have two types of fair value gap. One is just your normal fair value gap and the other is a breakaway gap. A normal fair value gap is formed when the third candle closes below the high of the second candle. It doesn't matter even if price has traded above the second candle's high. If there is a wick above the second candle's high, that's all right. All we are looking for is the closing, and if the candle close, the third candle close is below the high of the second candle, the gap that is then formed between the high of the first candle and the low of the third candle is called a normal fair value gap. And when a normal fair value gap is formed, what we are expecting, what we are projecting is that we can now possibly trade back into this gap and we can get an opportunity for a retracement trade. The other type of fair value gap is called a breakaway gap, and a breakaway gap is formed when the third candle trades over and above the high of the second candle and successfully closes above the high of the second candle. Here the momentum that was picked up by the second candle is continued by the third candle and it breaks away. It starts trading further away from the gap that it has left behind between the low of the third candle and the high of the first candle. Such a gap is called a breakaway gap, and here we expect higher prices to continue in the next couple of candles, and we don't expect a retracement back into this gap, at least till opposing liquidity is met, about which also we will learn later in this video series. So now let's look at how are fair value gaps formed. Fair value gaps, the concept is a part of smart money concepts, and what we do in smart money concepts is try to look for the footprints of big players, institutions. These big participants come with huge orders and have the capacity to move the market. Retail traders like you and me cannot move price by our participation. Our contribution is minuscule when it comes to moving price. We can participate in the market, but we can't decisively move the market. So at the center of a fair value gap is an expansion phase, the second candle, which actually creates the fair value gap. To create this expansion phase, we need the participation of big players, of institutions who come in with huge orders, big volumes, and can cause a massive displacement in price. That momentum that we see, those huge body, sudden big candles that we see, they can be created only when there are big orders, big players, institutional players who are participating in the market. And hence we can surmise that fair value gaps are formed when big players, big institutions decisively enter the market to move price in their favor, in the direction that they wanted to move, and are now, very important, able to sustain this momentum. That is when you get a fair value gap. That momentum cannot be sustained, then there will be no fair value gap. So what does a fair value gap indicate? When a fair value gap is formed, we know for sure that there are big players, big institutions involved, because only they can cause such a big displacement in price. We also know that now there is a strong momentum in a certain direction because of participation of these players, and they have made their intentions clear that they want to move price in a certain direction. What this also indicates is that now there are something called as pending orders. If they have decided to move price in a certain direction, if price comes in that fair value gap, it gives them an opportunity to enter the market at better prices. They will always have huge amount of orders that will be pending, that will be there in that fair value gap. This is when that gap acts as a support or a resistance zone, is because these big players who have moved price are waiting like a hawk to get better prices and again continue in that direction. Another thing that these fair value gaps tell us, that now there is an enhanced liquidity. See, when a market is in a range bound state, there are a lot of participants who are waiting on the sidelines, who don't like to enter when price is range bound choppy. But when we get big moves, then it also increases the participation of other players. You can also say other retailers who have been waiting for a momentum for price to finally get somewhere. And it also indicates that now there are some traders who were caught wrong-footed. Before price created that displacement, there were players who are now caught wrong-footed. All this information is very valuable to us. We are going to make good use of it. In the later part of this video series, you are going to see how. Now we are getting to the juicy bit. How do we use fair value gaps in our trading? I use fair value gaps for everything. Fair value gaps can help me determine the market direction in the short term and in the long term. They help me in defining clear support and resistance zones. They also show me a point of interest. This is the point, this is the zone where I look for certain changes, certain patterns that price makes to determine whether I should take an entry or not. Fair value gaps also give me an entry point, a definite level where to enter the market. They also help me to define and refine my stop losses. I also use them to trail my stop losses. And at the same time, they also give me a clear take profit level. So everything that we do in terms of trading in this strategy is going to be defined by fair value gaps. The best way for me to summarize what we have learned so far would be to take you through a trade that I actually placed, take you through the idea of how the trade idea was formed, the entry levels, the stop loss levels, the exits, everything, and show how I used fair value gaps in different ways to achieve a successful trade outcome. Let's have a look.
Hello guys, welcome to the end of the analysis for the 10th of April. As usual, we are looking at the Bank Nifty chart because that's what I trade. Alright, so this is today's daily candle. As we can see, on the left hand side is the futures chart. On the right hand side is the index chart. So first, let's go one time frame lower, that is 75 minutes, and we'll see what we did. This is today's first candle, as we can see. So we opened, we went up, we came down, we formed a kind of a doji, but still we had a much longer wick on the lower end as compared to the upper end. So we can consider this as a bullish candle. Later, we waited for the second 75-minute candle to close because there was a good possibility of a fair value gap being formed here. So once the second 75-minute candle closed at 11:45, we got this gap. I'm going to highlight that gap. So as soon as that happened, we were going to look for a bullish fair value gap going up on our lower time frame. Since our fair value gap is on a 75 minutes time frame, we are going to look for that on a 5 minutes time frame. It's very important to align your time frames correctly. So let's shift down now to a 5 minutes time frame. So after this fair value gap was formed, the first stab into that fair value gap came at 11:50. We also got a decent reaction up, if you see, between 11:50 and 12:10. But our setup says that we have to enter based on fair value gaps. And fair value gaps are indication of momentum. So that's what we look for. So though we got this up move, there was no fair value gap, neither on the index nor on the futures. So we waited. Price came back in here, and immediately after that, we got a big green candle which left behind a small fair value gap here. So this fair value gap would then become our entry. We still haven't stabbed into it, and I'll tell you why, and I'll tell you what I did, and which is why it is very important for you to look at time frames, look at all time frames, look at the higher time frame. Very, very important. The same thing happened in the index. The index did give you a stab into it, but for taking entries, I will prefer to use the futures chart because this is what is being traded. This is where the money is. The index chart is a reference for levels, but the actual participation is seen in the futures chart and further implied on the options chart, which are again going to respond to the futures premium. So let's see what happened. So we got this fair value gap at the close of the 1305 candle. So at 1310, we got this gap, but price did not trade back into it. Price continued to go up. When this happens, you have to do another thing and look at a time frame above it and see if there is another fair value gap above it which is preventing price from coming lower and tapping into your lower time frame fair value gap, because there's a bigger support above, and that's exactly what we saw here up above at the close of the 1315 candle, which is at 130. We got a fair value gap created on a 15 minutes time frame. Denote this, right? So once we got this, now all we had to do was tab into this. Price did not have to come all the way back down into this green 5 minutes fair value gap, because there was a fair value gap of a higher time frame which would prevent it, which would act as a bigger support, a bigger buffer for price to not come down back into this. So that is exactly what we got here. Our entry happened here at 130. Our stop loss was below here. So let's do that with a long position. Here was our entry. Our stop loss was under here, and our target was the extreme swing high. So it gave almost a 1:2 risk reward ratio. This was our entry and this was our target. After price traded above these highs, there were more opportunities to add to your position. You see this, we were waiting for price to break above these highs, and once price went back up, we put our stop loss here. What we also got was another small 5 minutes fair value gap, which could have given us another entry to pyramid into our winning position. Here you see this gap. This is where we could have added more, and now our stop loss was even lesser. We had refined our stop loss. The risk to reward was great, and we could easily pyramid into our position. And just in a couple of candles, we see that price goes on to hit our take profit. This was 100 points trade in options for me. I had bought the 48,600. This was my entry, and I got out here. It was a clean 100 points trade. I could clearly see the inner workings, what was going on. I didn't rush to move my stop loss too quickly. I knew there would be stabs back in. I knew there would be an attempt to pick up some liquidity like you see here. If you pay attention to the gaps, it will clearly tell you a story about what the market is doing, how it is working up towards a certain level, and where are your best opportunities to enter.
Thank you for watching till the end. If you feel like you learned anything of value, please don't forget to like this video and subscribe to our channel. If there is any particular video you would like me to make on any particular topic, then please mention it in the comment section. Till the next video, take care and trade smart.